Hi everyone, welcome to ACCA Taxation video lectures brought to you by AccountancyTube.com. In this video lecture we are going to look at inheritance tax. We've already finished our capital gains tax and we finished income tax as well. So we finished income tax and capital gains tax. Now capital gains tax is more related to inheritance tax as well. Sometimes the same transactions will be affected, same transactions will have effect in inheritance tax and also in the capital gains tax. So that is important from that point of view as well, because both of them are capital taxes. They are not tax on the income, they are tax on the capital. So that's why they will have similar transactions. They will be gifts from individuals or to a trust, and so they will have impact in capital gains tax and they might have an impact in the inheritance tax as well. Now inheritance, as the name says, so whenever a parent, whenever the parent dies, so they will have some estate which will be transferred eventually to their kids or whoever they intend to transfer. So at that time there will be some tax to pay, and that is known as inheritance tax. So the estate which is received by the kids normally, so by the children normally, so they will have to pay tax on that estate. Likewise, there will be some tax when you are giving the gift during lifetime. So there will be some taxes during lifetime as well. So that is also part of the inheritance tax. So don't just think that it will be tax on the death. There will be tax during lifetime as well. All right? So we will see the inheritance tax in details in this lecture, and gradually, while so we will see one topic from the lecture notes. Then we will do one exam kit question as well. So we will see one topic exam question relevant to that. So it will make your concepts even stronger. I'm using F6 and F6 lecture notes in this video lecture. However, this same material is given in the P6 notes as well. So I'm making just one single video for F6 and P6 students. For P6 students, you can find the lectures in the P6 section. All right? Right then, so because the material is exactly the same, and also I will be using F6 notes in this video lecture, and also we will be doing questions from I will be doing questions from BPP exam kit, F6 exam kit. So there will be small questions just relevant to F6, not so much for P6. But for P6 student, it will be good practice because although there will be small questions, but they are good for practice. All right. For P6 students, we will do some additional questions as well in our P6 section. However, for F6 students, these are more than enough which we are going to do. So I will tell you even if there are some more additional questions as well from exam kit. Right. So before we move to our lecture notes, I have listed down something here on the board, which is basically a summary of whatever we will be doing during this lecture, whatever we will be studying in this lecture, and the questions which we will be doing. So basically, please, if you want to note down this thing, note down on your notebooks, please. Just pause the video and note it down, please. First of all, it's a time of transfer. So whenever we are making the transfer, that is the time of transfer. Now for inheritance tax purposes, there will be two times of transfer. Either I will be transferring during my lifetime, or it will be transferred on my death. All right, so it is a during lifetime transfer and transfer at death. So someone either will be transferring during his lifetime or he will be transferring at death. Now types of transfer, so for lifetime it's different and for death it's different. So during lifetime there will be two types of transfer. One is PET transfer, which is potentially exempt transfer. That's why we call it PET. So it is potentially exempt transfer. Another one is chargeable lifetime transfer. So CLT is known as chargeable lifetime transfer. Right? Now PET, which is potentially exempt transfer, it means when an individual transfer an asset to another individual. So when it is a gift from one individual to another individual, that is called potentially exempt transfer. So that is PET. However, for chargeable lifetime transfer, it is a gift from one individual to a trust. So it is not from one individual to another individual, or it is from an individual to a trust. Right? So this PET thing, it is from individual to individual. So this thing is from individual to individual. Whereas this CLT thing, this is from individual to a trust. Right? Now, what is trust? Whenever a parent are thinking that we might die soon, so that we want to give our asset to our children, but they are not old enough to look after that asset. So then they will make an agreement with the trust. So that will be a body. So they will transfer the asset to the trust. So when their kids will come to the age of 18, then trust can transfer them assets to the children, right? So say for example, Mr. A and his wife, they thought we want to transfer our house to our children, but they are so young they can't take care of the house. So they then decided to transfer that house to a trust, not immediately, but upon their death. So they have written an agreement that upon our death, this house will be transferred to a trust who will look after the house, so that when the kids will be of age of 18, then the trust will transfer the house to the kids. All right, so that is the basically aim of the trust. So they will be just looking after the assets, so they will be taking care of the assets. Otherwise, if they transfer to a random person, so they might not trust them. All right, so trust is basically an organization which will be looking after the asset, and there will be few people who will be managing different assets. So then they will transfer on a specified date when the children will become of the age. All right, so that is basically chargeable lifetime transfer. So potential exempt transfer is a gift from one individual to another individual, and whereas a chargeable lifetime transfer is a gift from an individual to a trust. Right? Now after that it says a lifetime transfer. As I said, there will be two types of transfer. One will be lifetime transfer, another will be death transfer. So types of transfer, one is lifetime transfer, another one is death transfer. Now this is the time of the transfer, and this is the type of transfer. Please make sure do not confuse these with each other. Right? Now types of transfer, it says lifetime transfer, calculate using nil rate band during lifetime. Now nil rate band, what is nil rate band? Now we will calculate the value of the estate, value of the assets which were gifted. Now up until £325,000, there will not be any inheritance tax. So that is known as nil rate band. Right? So up to £325,000, there won't be any nil rate, there won't be any inheritance tax. Likewise for death as well, calculate using nil rate band, but there will be different nil rate band at death. So there will be separate nil rate band during lifetime, and there will be additional nil rate band of £325,000 at death. So there will be two nil rate bands. One will be for lifetime, another will be for the death. Right. So I've left this space to ask you a few questions, that whether there will be a tax or not, and how it works. Now, time of transfer is a lifetime. Now, if we are transferring a potentially exempt transfer during our lifetime, if I have gifted from one asset to another individual, so if it is a gift from one individual to another individual and it is during lifetime, there will not be any tax to pay during our lifetime. So there will not be any tax to pay, any inheritance tax to pay during our lifetime. So that is a lifetime transfer. Right? So if it is a gift during lifetime and it is a gift from one individual to another individual during lifetime, there will not be any tax at all. However, this same tax might have tax on the same asset might have to be paid on an individual's death. Right? So as I said, there will be two impacts. One will be impact during lifetime, another will be impact on death. Now, whenever one individual has transferred an asset to another individual, there will not be any tax during the lifetime. However, there might be tax on death. So how would there might be a tax during on death. However, tax will only be paid if donor dies within 7 years. of gift. Right? So tax will only be payable if the donor dies within 7 years of making the gift. So if an individual transferred a gift to another individual, there will not be any tax. However, there will be tax payable if the individual dies after making the gift, if the individual dies within 7 years of making the gift. However, if the individual survives for 7 years, then there will not be any tax on death as well. So no tax during lifetime, no tax during death if he survives for 7 years. Right? Now come to the chargeable lifetime transfer. Now this is a transfer from one individual to another trust. There will be a tax to pay during our lifetime. So we will have to pay tax on during our lifetime, and there will be tax on death as well. Again, tax will only be paid if donor dies within 7 years of gift. However, we will use gross amount here, so use gross amount. Gross amount must be used. Right? Please make sure you write it down that gross amount must be used. However, for this one, it's not a gross amount. Sorry, this one, it's not a gross amount here, but it will be gross amount here. Right? So what will be the gross amount anyway? So we will take the amount of the gift plus the tax which is to pay. We will take the amount of gift plus the tax which was paid during our lifetime. So it is amount of gift plus the tax. So that's why it is gross amount. All right. So the tax will be paid on the gross amount on death. Now let's come to we are at the time of transfer. If it is a transfer at death, so if it is a transfer at death and the type of transfer is at death as well, then during lifetime there will be any tax on during lifetime? No, because the gift was transferred at death, so of course there will not be any tax on during our lifetime, so there will not be any tax during our lifetime. However, there will be tax on death because it is a death estate, so we will have to pay tax on death. Alright, so there will be tax to pay on death. Right then, so I hope that you have got it and you have noted it down as well. Now let's move to our lecture notes, please. If you could open your F6 lecture notes, please. Let me open them through the screen share option as well, so that you can also see on the screen. In the meantime, as I said, please make sure you note it down, whatever I have noted down on the board, so it will be helpful for you while you're revising for your exam. Right? As you can see on your screen, it's inheritance tax. So chapter number 18, 19, and 20. Let me leave it here, so we will do these questions later on. Right, so chapter number 18, 19, and 20, it is inheritance tax, as you can see on your screen. Page number 66 of your F6 notes. For P6 students, please keep watching this video lecture. After end of this lecture, go to your P6 notes. You will find almost the same stuff there. Even if there are stuff which you can't find, you will have another lecture on that, so don't worry. Alright, so chapter number 18, 19, and 20 for F6 students, we are using F6 lecture notes. As you can see on your screen, page number 66, inheritance tax. Right, so all transfers of assets worldwide made by a person's domicile in the UK, whether during lifetime or on death, are within the charge to IHT. As I said, whether it is during lifetime or on death, we will have to pay inheritance tax. We might have to pay. So it's not death, only tax on death. There might be tax during lifetime as well, as we have seen on our board, on this thing on the board. Right, and the chargeable person for IHT purposes are individuals and the trustees. Right. Now, there are two main chargeable occasions for individuals. Now, gifts made during lifetime, as I said, and gifts on death, as I've shown you on the board. Now, you can't see the board because it is in the screen share mode, so that's why I asked you to note it down, so you will have this in your notebook. So whenever I point it out, just look at your notebooks. Right, so after that it says inheritance tax, tax year 17-18. So for our current tax year, nil rate band is £325,000. So first £325,000 you will not have to pay any tax on that. And you will also get a resident nil rate band. Now there is a new nil rate band for our current tax year. It was not in our syllabus in the previous tax year, so it is new. So first £100,000, on first £100,000 you will not have to pay any tax on that. Now this is on top of £325,000. Now £325,000 is a normal nil rate band, whereas this residence nil rate band is £100,000, so that is on top of that. But please remember, it is the residence nil rate band, so it is only be used on the main residence. So whenever there is a transfer of a main residence from an individual to a direct relative, where there are children, in most cases they are children. So there's just maybe 1 second. Let me drink some water. Right. So first, sorry, I was talking about the residence nil rate band. So as I said, it will be main residence, which is transferred from a parent to a direct relative. So in that case, first £100,000, you don't have to pay any tax on that. However, sometimes that main residence has some mortgage as well attached to that main residence. So we will deduct them expenses out of that property, and the net amount will be the one against which we will use the residence nil rate band. And please remember, this is £100,000. So if the net amount of the property, net amount of the residence, excuse me, is less than £100,000. So say for example, the value of the property was £120,000, but relevant expenses of that property was £40,000. So 120 less 40 is equal to £80,000. So in that case, residence nil rate band will be restricted to £80,000. So we can't use the remaining £20,000 of the nil rate band against other assets. All right, so it is maximum of £100,000, but it might be lower than that if the net value of the property is less. All right, and any excess will be taxed at the rate of 40%, and if it is during lifetime, HMRC says if you pay during lifetime, you will have to pay half rate of that, which is 20%, not 40%. Right? Right. After that, we'll look at residence nil rate band, as I said. Just pay me 1 second, let me find out where I was. Was I using yeah, I was using the other note, sorry. Right, so you're fine. So residence nil rate band, as you can see on your video screen. So if an individual dies after start of the current tax year, so if he dies after 6th of April 2017, so our tax year starts from 6th of April 2017, isn't it? So it starts from 6th of April. And the property is left out to a direct relative, which is children or grandchildren, and property include the main residence, so it must have main residence in them. Only then we can use it. Then first £100,000 will be taxed at the rate of 0%, which is a nil rate band. And it says, note, the residence nil rate band does not apply to lifetime transfers becoming chargeable as a result of donor's death within 7 years. So if you have made a transfer during lifetime, which will then become chargeable at death, we can't use residence nil rate band against such assets. Right? So that is our residence nil rate band. And please remember, both husband and wife will have separate nil rate bands. So if there is a couple, husband will have separate residence nil rate band, and the wife will have separate residence nil rate band. Now, in a case where husband died and husband did not use any of his residence nil rate band, then unused amount of residence nil rate band will be transferred to the wife or the surviving partner, if it is husband or wife. So if husband died earlier, he will have, say for example, £100,000, whole amount of residence nil rate ban was unused, then whole amount will be transferred to the wife. If there was £50,000 unused and £50,000 was used, then the remaining amount, which is the unused residence nil rate ban, will be transferred to the wife. All right, and then wife can use then the wife can use upon her death. So whenever she transferred the assets on her death, then that £200,000 can be used against such estate. All right. Right then, so after that, lifetime transfers. Now, lifetime transfers, there are two types of lifetime transfers for IHT purposes. One are potentially exempt transfers, as is listed on the board, and other ones are the chargeable lifetime transfers. I've already explained you what these are, so you do not need to look into the definitions of these. However, just beneath that it says a pet is exempt from IHT when made. As I said, we will not have to pay any tax when it is gifted during lifetime, because it is from one individual to another individual, and it will remain exempt if individual survives for 7 years. So it will only be tax will only be paid if the donor dies within 7 years of making the gift, right? And after that it says if the transfer dies within 7 years of making the gift, it will become chargeable. Right then, after that there are few exemptions available. So what are these exemptions? Now, exemptions applying to potentially exempt transfers only. So these exemptions will only apply to potentially exempt transfer only. Small gift exemption: outright gift to individuals totaling £250 or less per donee. It's not done, it's donee. Per donee in any tax year are exempt. So if you give £250 or less than that to as many individuals as you want, you can gift that. However, if it exceeds that, then it says the whole amount is taxable. Alright, so £250 or less per donee in any tax year are exempt. If gifts total more than £250, the whole amount is chargeable. The donor can give £250 for as many donees as he wishes to do so. Right? Right then, so after that, on the next page, page number 50, exemptions applying to potentially exempt transfer only. Now let me see if we can do any questions with regards to that. Just give me 1 second. We have seen residence nil rate ban, but we haven't seen how to calculate the IHT. So let's move on, we will do the questions in a minute. Exemptions applying to potentially exempt transfer and chargeable lifetime transfers only. Now these are the exemptions which apply to PET and CLT both. So annual exemption, every year you will get £3,000 annual exemption. That £3,000 is available every year, which you can use. And if you have any unused from the previous year, you can use that as well in the current year. So that's what it says. The first £3,000 of the value transfer in a tax year is exempt from IHT. Annual exemption is used only after all other exemptions are used by PET as well as CLT. So this is the last exemption to use. So we'll use all other exemptions first, then we'll use this one. Any unused portion of the annual exemption is carried forward for 1 year only. Only use it in the following year after that year's own annual exemption has been used. Right, so that is our annual exemption. And it is an exemption which applies to potentially exempt transfer and chargeable lifetime transfer. Now, if you are giving a gift on occasion of marriage, if someone is getting married and you give some gifts, now these exemptions will be applicable at that time. Now, if £5,000, if from a parent of a party to the marriage, so if a parent is giving the gift, so it will be £5,000, it will be exempt. £2,500 if it is a grandparent, and £1,000 if any other person is giving it as a gift on occasion of marriage. And after that, exemptions applying to potentially exempt transfer, chargeable lifetime transfer, and death transfer. And there is only one exemption, which is a gift between spouses. So if one person gives gift to another person, they are married couple, they could be husband and wife, man and a lady, or they could be same-sex couple as well, if they are married. So the gift between this couple, there will not be any tax on that. It will be exempt. All right. Now after that, normal expenditure out of income. Now when I started this lecture, what did I tell you first? The first thing which I tell you that it is a tax on capital. It is not a tax on income. All right. So if there is a gift of income, then we will not have to pay any inheritance tax on that. All right. Now let me drink a glass of water and please read this thing, normal expenditure out of income. Just give me 1 minute and just read it, please. Right then, it says that it is made as part of normal expenditure, part of normal expenditure of the transfer. If it is normal expenditure of the transfer, then it will be exempt. If it is made out of income instead of capital, or it leaves the transfer with sufficient income to maintain his standard of living, which means that I am so rich, I am earning £10,000 a month, and if I give £100 to my grandchildren, it won't harm my life. It won't harm the way I am living, so I will keep living the way I am living. So if it is such a minor amount, then it will be exempt, and because it is expenditure out of income. All right, and examples include child's school fee, payment of life assurance premium, household monthly expenses, etc. Now examiner might give you some of these expenses in the question, and he might ask you that then you will have to identify that these will be exempt because these are the expenditure as part of the normal expenditure and normal expenditure out of the income. Then you will have to identify why these are exempt. All right, because it is a normal expenditure of the transfer, or made out of income, or it leaves the transferor and his life as it was before. Now evaluation of assets for IHT purposes, diminution in value. That is very, very important concept to understand for inheritance tax. Now whenever I am giving a gift, normally I take the price, the actual price of that gift. Now for inheritance tax purposes, the value of transfer will be calculated in a different way. Now I will see that what was the value of my estate, what was the value of my total estate before I transferred the gift, and after transferring the gift, what was the total value of my estate after transferring the gift. So whatever the difference is before and after, that is the value of transfer. Now that especially applies, and you can easily understand, when these are shares. Now I hope that at this level you know that say for example, if I hold 50%, the 51% of a company, then I have controlling, then I can control that company. All right. Now, if I can control that company, that if I have 51% shareholding, I can control that company. And say for example, if I have 45% shareholding, and I am looking for another 6% shareholding, so that I can have a control within the company. Now, the remaining 6% which I want to buy, I will have to buy it at a higher prices, because everyone in the company knows that I have 45% and I am looking for the control, so that everybody will be asking for good price, because they know that after getting that I will have the control. Right. So likewise, the more closer I get to the 50%, every next share will be expensive for me. Right. So likewise, they say for example, if I hold 70% share in a company, the shares which I hold, share price of my shares will be a lot higher than the person who hold only 1% shares in the company. Alright, because I have a control, so my shares are expensive than his shares. Alright, so if I hold 70% shares in a company, my total worth will be a lot higher than in the case if I hold 40% shareholding in the same company. Alright, so likewise, there could be circumstances when in the question the examiner can give you a scenario that an individual had 70% shareholding, then he transferred 20% of that, so the remaining shareholding is 50%. So in that case, you will have to see what is the value before transfer of the transfer, what is the value of the transfer after transfer. So the remaining amount is going to be the diminution in value. Remaining amount is going to be a gift value for IHT purposes. Right, so as it says in the notes as well, please read it. Now on the next page, which is page number 51, lifetime tax on lifetime transfers. Now, before I move to this topic, let me do a question as well. Let me just bring the list of the questions which I have here. So diminution in value. If you could open your BPP exam kit and come to page number question number 158, please. Question number 158 of the BPP exam kit, F6 exam kit I am talking about. So question number 158 of BPP exam kit, as you can see on your video screen. So that is question number 158. Now that is relevant to diminution in value, as I said to you. So what is the diminution in value? I've already explained you enough. Now just pause the video here and try to solve this question for me, please. Just pause the video and tell me the answer of this question. Right, I hope that you have already done it. So let's read the question. G owns 70% shareholding in R Limited. Now let's see how much is the price of 70% shareholding. Beneath that it's £350,000. So that is the price of 70% shareholding. An unquoted investment company on 23rd of July 2000, she gave 20% shareholding in R Limited to her son. So value of 20% shareholding is £80,000. Value of shareholding in R Limited were as follows. What is the diminution in value in Gillian's estate as a result of gift on 23rd of July 2017? 20% has already been given, remaining amount is 50% shareholding. So answer is £200,000. Right? So value transferred is so the value before transfer was £350,000 and the value after transfer is £200,000. So the remaining the difference is we'll take value before transfer £350,000 and the value after transfer £200,000. So the diminution in value is £150,000. So that £150,000 is the answer, and that will be used for our taxation purposes, for our IHT purposes. Right? Going back to our lecture notes, and now diminution in value, there is another question as well in your exam if you want to do. Question number 164 is also exactly on this same topic, diminution in value. So if you want to use that, so you can do that as well. Alright, so let's move to our lecture notes again, please. So lifetime tax on lifetime transfers, page number 51. Lifetime tax on potential exempt transfer, as I have listed here as well, there is no tax during our lifetime on potential exempt transfer. Lifetime tax on CLT, I told you that yes, there is a tax on CLT during our lifetime, and we know that death tax rate, how much is the death tax rate? Tax at death is 40%, and if you are paying during lifetime, it will be 20%. Alright? Now when we are talking about the CLT, chargeable lifetime transfer, now there will be two kinds of calculations, because it is the chargeable lifetime transfer, so the transfer from an individual to a trust. Now in that case, sometimes what happens is that the transferor who is giving the gift to a trust, the transferor says, I will pay the tax, so do not deduct the amount from the trustee. Alright, so please give the whole amount to the trust, do not deduct any tax from the trustees, I will pay the tax. Who is saying? Transferor is saying. Now in that case there will be a different tax rate, and in the case where the HMRC will deduct from the pocket of trustees, in that case there will be different tax. Alright? Now when the individual says I will pay the tax, the transferor is saying please give them full amount, I will pay the tax. In that case HMRC says I don't trust you, you will have to pay tax at the rate of 25%. Now normal lifetime tax is normal lifetime tax rate is 20%, which is half of 40%. However, if individual says I will pay the tax, then HMRC says please pay 25%. If the trustee is paying, in case of trustee, because HMRC can always sell that asset and deduct the amount, so HMRC is a little safe, so they will charge 20%. However, how to calculate it? So let's see. Lifetime tax on CLT, as you can see on your screen. If the transferor, individual, pays the tax, when the CLT is made and transferor, individual, pays the lifetime tax, follow these steps to work out the lifetime IHT on it. So these steps we will have to follow. First step is look back 7 years from the date of transfer to see if any other CLTs have been made and calculate how much of the nil rate band has been used while how much is remaining. Now we'll have to see the date of the CLT, when the CLT was made, and we'll have to see 7 years before that how many CLTs were made or potential exempt transfers were made before that. Now the same nil rate bands, £325,000, will be used against them assets first, and then any remaining nil rate band will be used against this asset, right? Now any part of the CLT covered by the nil rate band will be taxed at the rate of 0%. Any part not covered by the nil rate band will be taxed at the rate of 25%. Why 25%? Because the individual is paying, the transfer is paying. Alright? And finally step 3 says that work out the gross transfer by adding the net transfer and tax together. This is the gross value of CLT on which the death tax will be calculated if the transfer dies within 7 years. As I said, you hear that on this last section of CLT, that tax will only be paid if the donor dies within 7 years, and we'll use the gross amount must be used, so that we'll take the net amount plus the tax which was paid during lifetime. So then the gross amount, death tax, will be calculated, right? So that is when a transfer is paying. We had to look at when the trust is paying first. However, I looked at the transfer first. So basically, when the transfer is paying, there will be 25% tax, and when the trust is paying, there will be 25%. When the trust is paying, there will be 20%. So just it is exactly the same thing which I've just told you. So you just had to revise it from the lecture notes, right? So there will be exactly the same. It is exactly the same way to do this calculation. Right, after that, advantages of making lifetime transfers. So what are the advantages of making lifetime transfers? This is a very, very important list for both F6 and P6. Very, very important. So it is just a theoretical base. So these are most obvious ones, most of them are. So let's read them so that you will understand them as well. So if the donor makes a potentially exempt transfer, so if there is a gift from one individual to another individual, then it will become exempt from IHT. Why would it become exempt? Because we are giving it during lifetime. What are we reading? We are reading advantages of making lifetime gift. So if it is a pet, if I am giving during lifetime, it will be exempt, and it will remain exempt if I survive 7 years. And after that, it says if a donor makes CLT and survives for 7 years, so if I am giving it as a CLT, is a chargeable lifetime transfer, during lifetime, if I survive 7 years after CLT, then the overall IHT will have been reduced, as there will be no additional IHT on death. Alright? So if a donor makes a CLT and survives for 7 years, so I will already have paid enough tax, so there might not be any additional tax to pay on death. Alright, so the earlier gift I give, the chances are I might not have to pay tax on death. Right, then after that it says availability of annual exemption, small gift exemption. So these are the exemptions which are available only if you make a gift during a lifetime. And if the value of property is to be transferred is appreciating in value, sometimes properties of a kind which is appreciating in value, say for example a building or land. So that is a kind of asset which increases in value with the passage of time. So if it is such an asset, then it will be beneficial to gift it during our lifetime, because even if we die within 7 years, then the tax will be paid on the amount when the gift was made. So it will be fixed at that amount, and by the time of death, the value of the asset might have been increased, but the tax will only be paid on the price when the gift was made. That is basically aim of this. That is basically the benefit of this. All right. So after that it says if donor does not survive for 7 years after making lifetime transfer, even if I have made a gift during our lifetime, even if I does not survive for 7 years, even if I do not survive for 7 years and I die before 7 years, I will still get some amount exempt under taper relief. Right, so taper relief will be available, which is an exemption, assuming I live 3 years after making the gift. All right, so we will see what the taper relief is later on. Now on the next page there are other factors as well. So we have seen that there are benefits, there are advantages of making a lifetime gift, but before making lifetime gift there are some other factors as well which we must consider. Right, so what are these? CGT implications. We will have to see the CGT implications during our life. If we are giving a gift during our lifetime, we will have to see what will be the CGT implications, because at the same assets we might have to pay capital gains tax as well. Alright, now it should be considered that whether the donor can afford to make the gift. So I mean, you can't do like if you had just one house in which you are living, if you have gifted that house, where would you go? Right, so you can't do it like that, so you will have to consider that as well. Right, and it is important to consider after making the gift whether the donor will be able to live comfortably, particularly in old age, especially in the UK and United States, that if you are old and you are living with your kids, and if you transfer your house to your kids, so they might kick you out of the house, all right, so they might send you out. So that is that's what you should consider, all right, particularly in the old age. So you do not want to spend your life in a council house, all right. So on the same page, on page number 52, death tax on lifetime transfers, potentially exempt transfer and CLTs. So how to calculate the death tax? As you know that there was no tax on potential exempt transfer during our lifetime, but there will be tax on death. So however, for CLTs we would have already paid some CLT tax during our lifetime, so we will deduct that tax which we have already paid during our lifetime. So we won't be paying double taxation. The tax which we have already paid during our lifetime, that will be deducted. Right, so how to calculate? Let's see. If transfer dies within 7 years of making a pet, it will become chargeable to death tax. Also, all CLTs made within 7 years before death will become chargeable for the death estate, for the death tax. Remember, calculate lifetime tax on CLTs first, then move on to death tax. So we will calculate during our lifetime, tax during our lifetime, then we will move on to the death tax. All right? And then after that it says, follow these steps to work out the death tax on pets and CLTs. First step is to look back 7 years from the date of each transfer to see if any other chargeable chargeable transfer CLTs or pets have been made. If so, they will use the nil rate band, and the remaining nil rate band will be used against the new assets. Any part of the CLT and pet covered by the nil rate band will be taxed at the rate of 0%, and any part of the CLT not covered by the nil rate band will be taxed at the rate of 40% because it is the tax at death. Note the gross amount of CLT will be used, which was worked out for computing lifetime tax. As I said earlier as well, we will use the gross amount, as you can see here as well, where the CLT, last section of the CLT, will use the gross amount on death while calculating the tax at death. So we'll take net amount plus the tax which was paid during our lifetime. And in step 3 it says, in the step 3 it says reduce the tax by taper relief. And in the step 5 it says deduct any lifetime tax paid. This will be only applicable for CLT, because for PET we would not have paid any tax during our lifetime. All right. And what is taper relief anyway? So it says that if you survive 3 years after making the gift, so if you have survived 3 years, then the taper relief will be 20%. However, if it is less than 3 years, there won't be any taper relief. Likewise, it will keep increasing by 20%. So from 4 to 5 years, it is 40%. From 5 to 6 years, it's 60%. 6 to 7 years, so more than 6 years, but less than 7 years, it is 80%. And what would happen if it is more than 7 years? So if it is more than 7 years, it will be exempt anyway. All right. So if we have survived for 7 years, it will remain exempt. Doesn't matter if it is a PET or it is a CLT. Right, on next page, page number 53, please. If you come, page number 53. Now on page number 53 it says the death tax on death estate. Right, so there will be death estate as well, apart from the gifts. So we might be giving the gift during our lifetime on death, but there will be death estate. So whenever someone dies, there will be some death estate. So there will be properties owned at that properties with the name of that deceased person. So how to calculate that? So compute the value of the death estate. So we'll make a pro forma, look back 7 years from the date of death to see if any CLTs or PETs have been made, to work out the remaining nil rate band. Any part of the death estate covered by the nil rate band at the rate of 0%, and not covered by the nil rate band at the rate of 40%. So there is a death estate pro forma given to you just below. So we will list down all the assets, and if there are any liabilities against them, we will deduct them as well. So as you can see, stocks and shares, insurance policy proceeds. So if there was any insurance on that deceased person, so you will have received insurance proceeds. So that will be income. So that will be added as well. Personal chattels, then all these assets, income tax refunds if you have received any. and less debts due by deceased person, that will be deducted as well. Funeral expenses, reasonable amount of funeral expenses will be deducted. And then freehold property, if there is any, and if there are any mortgages, we will deduct them deductions against that specific property, and that will be our net estate. Let's exempt legacy to spouse. If anything is transferred to the spouse, that will be exempt. And then after that, the net chargeable estate. All right. Now sometimes there will be estate, and in a will, the deceased person has written that I had a estate of £1 million. I will transfer this amount to my son, that amount to my daughter, and the remaining amount to someone else. Right. Now, if it is like that, the eventual person, the person in which in the statement, if it says the remaining amount will be transferred to my eldest son, say for example, then the eldest son will have to pay all the tax on that estate, not the other persons. So the person if the deceased person has specified that that is the amount which will be transferred to that person, so we will have to transfer that exact amount. When it says the remainder amount will be transferred to that person, now the remainder person will have to pay all the inheritance tax and death estate. All right, so that is a very, very important thing to remember. Right, so let's move forward. On the next page, debts and funeral expenses. So there isn't anything tough here, anything difficult. Only debts incurred by the deceased bona fide for full consideration may be deducted. Gambling and other debts cannot be deducted, which is on the promises. Rent and similar amounts which accrue day by day should be accrued up to the date of death. Taxes to the date of death may be deducted. And debts incurred by the executor are not allowed. All right. If a debt is charged on specific property, is deducted primarily from that property. Right, and who is executor, by the way? Executor is the person who is looking after these affairs after someone is died. Right, so that will be the executor. Right, then after that, so that's why it says that debts incurred by the executor are not allowed. So who will be doing all these taxes and stuff? That deduction is not allowed of that. Right, and after that it says if the foreign debt exceeds the value of debts contracted abroad must first be deducted from the non-UK property. So if there is anything left, then we will deduct it against the UK property. Reasonable funeral expenses and the cost of tombstone is also deductible. A transfer of unused nil rate band, as I said to you earlier as well, but that was with regard to the residence nil rate band. Now, residence nil rate band will be transferred to the remaining spouse, the surviving spouse, which eventually is died, but it was survived when the first spouse was died. So likewise, the unused nil rate band, the normal nil rate band of 325,000, that will also be transferred to the surviving person, right? But there will be circumstances when the first person of the spouse was died, the nil rate band was, say for example, £200,000, but now it's £325,000. So we will have to see the current. We will have to see that how much was the unused nil rate band at that time, and how much was percentage of unused nil rate band according to that old nil rate band. Now we will see that percentage, and then we will apply that percentage to the new nil rate band. So we will then add that amount to our new nil rate band. Now say for example, the old nil rate band was £200,000 and the unused percentage was 10%. Now that will take that 10% and then we will apply that to the new nil rate band, £325,000. So our current, for our new surviving spouse, there will be his own nil rate band of 325 plus 10% of the previous one. So 10% we will apply on the current rate. So 325 times 10%, 32,500. Right? So that's how we calculate it. And that will be added. Likewise, so if you come to the next one, so just read it through, so I won't go through it again. So basic tax planning for IHT purposes. Donor must make maximum use of exemptions like marriage exemption, annual exemption by considering appropriate time of making the gift. So if you had to give the gift of iPad to your daughter, so why not give it on the at the time of her marriage? So it will remain exempt. All right. Likewise, we'll have to see for everything, every other thing as well. So we must make use of our exemptions. Donors should make gifts in early life so that there is a less chance of pet becoming chargeable. If you give early in the life, so chances are that you will survive for 7 years, which means pet will not be chargeable at death as well. Pet is not chargeable during lifetime anyway. Right, so after that, donor should consider making the use of available nil rate band when transferring to a trust, and transfer not exceeding the available nil rate band will give no rise to the lifetime transfer. So we will, if we make a gift, even if we have to pay tax at death, but up to the nil rate band, £325,000, there is no tax anyway. All right. Right then, after that it says that a donor should consider making a gift to grandchildren instead of children. That is known as skipping a generation. Now sometimes if you are giving a gift to your son and you know that your son is going to gift that same property to their children, so why not just skip a generation? Instead of gifting it to your children, why not just give it to their children, so that you are skipping one generation, and so likewise you are skipping one inheritance tax as well. Right? So otherwise you are paying tax when you are transferring to your son, then he had to transfer to their son as well shortly after that, so they will be paying tax as well. So there will be two taxes, so you can skip the generation, and so that you will have to pay less IHT. Right? Let's look at the due dates as well on the next page. I think they're due dates, aren't they? On page number 55, yeah, due dates. Now on page number 52, these are the due dates of paying the tax. Right, so liability for IHT and due dates. For lifetime tax on CLTs, so chargeable lifetime transfers, we know that lifetime tax is only paid on the chargeable lifetime transfer. There is no lifetime tax on on potential exempt transfer. So if there is a lifetime tax for CLT, the due date will be later off. So the due date will be later off what? 30th of April, just after the end of the tax year of transfer. So 30th of April after the tax year of transfer, and 6 months after the end of the month of transfer. So whichever is later, that will be the date. Now after that, tax arising on free estate at death is payable by the personal representative or the executor. The time limit for this is 6 months from the end of the month in which the death occurred. And likewise for tax arising on death in respect of pet and CLT will be paid by donee within 6 months from the end of the month of death. Alright? So these are our due dates. Now we will do a question which is relevant to the due dates now. I hope that you're comfortable with the due dates, aren't you? Are you comfortable with the due dates? Shall we do a question? Right, so due dates, question number 167, my information says. Question number 167, as you can see on your screen as well. Right, let me open up this question as well from your BPP exam kit. Question number 167. Yep. Now it says Ruth made chargeable lifetime transfer of £750,000 on 18th of June 2017. Ruth died on 10th of July 2017. So he died on 10th of July 2017. Match the dates by which the lifetime inheritance tax and the inheritance tax arising as a result of Ruth's death will be payable. So when would be the lifetime tax payable? Lifetime tax will be payable on 30th of April after the end of the year of gift, or the 6 months after the 6 months after the month of 6 months after the end of the month of death. Alright, so we'll see whichever is later. Now death has occurred on what date? Death has occurred on 10th of July. So 6 months after that is going to be, so we'll see end of this month. So death has occurred on 10th of July, end of the month is 31st of July. So after that 6 months, so July, August, September, October, November, December, Jan. So 31st of January will be the one for 6 months one, and the other one is 30th of April after the end of the tax year of death. So 30th of April is later on, so we'll put the 30th of April. So lifetime tax will be paid on 30th of April, and after that it says death tax. What does it ask? Inheritance tax arising as a result of deaths, Ruth's death will be paid. And as far as tax on death is concerned, it is always paid within 6 months, right? So 6 months. So after 6 months is going to be 31st of which one is it? 31st of January, yeah, 31st of January. So death tax on 31st of January and lifetime tax on 30th of April 2018. right? So I hope that you got it and you did that as well. Now let's move to another question. Question number 159, please. Let's do question number 159. Question number 159. Please pause the video and do this question for me, please. It is about unused nil red band. We know that unused nil red band can be used by the surviving spouse, which is died now, but it was survived when the earlier one was died. So it is question number 159. Just pause the video and do this question, please. I hope that you have done it. So let's see. Joel and Sonita were married couple. Sonita died in July 2008. 65% of her remaining nil red band of £12,000 was unused. So he's already told you it is £65,000. Sorry, it is 65%. Normally it does not give you the percentage. Normally it will tell you that £40,000 was used out of £312,000. Then you will have to calculate the percentage. In this case, he has already given you the percentage. So easy peasy lemon squeezy. 65% of the current the nil red band, whatever would that be, so we'll use that. Alright, so £12,000 was unused. 65% of £312,000 was unused. Joel died in May 2017. He had a potentially exempt transfer after all available exemptions of £75,000 in August 2013. Joel left his estate to his sister. Any relevant elections were made. What is the nil red band available to set against Joel's death estate? So what would be the available nil red band to set against Joel's estate? Joel's death estate. So the nil red band was £325,000, which is for our own self. We will add 65% of that as well into it. So we'll take 65%, and out of that £75,000 will be deducted. All right. So whatever the 75. So we'll take £325,000 plus 65% of £325,000, which is for our which is unused from her husband. So that will be 2, and then we will deduct £75,000. So 75,000. So this nil red band will be used against the potential exempt transfer first. All right. So then we will use against the death estate. So the remaining amount of nil red band will be used against the death estate. So whatever the answer is, just check it on your piece of paper or calculator. Right, so that was question number 159. Now the next question is question number 160. Question number 160, please. Just move to question number 160, please, and do this question. As you can see on your screen, so it is exactly on the same screen anyway. So question number 160, please. Please do this question. How much IHT will be payable by Paul on the December 2017 value of transfer? Just pause the video and do this question as well, please, for me. Right, on the 7th of July 2012, Paul made a gross chargeable transfer. See, it is a gross amount of chargeable transfer. So it is a gross chargeable transfer after all exemptions of £260,000. On 19th of December 2017, he gave £190,000 to a trust. Paul agreed to pay any lifetime inheritance tax due. How much IHT will be payable by Paul on the December 2017 transfer of value? Now, on December 2017, he made a gift of £190,000 to a trust. Now, £190,000 he gifted to a trust on December 2017. Now we will use we'll take £190,000. Then we will deduct the annual exemption of current tax year, which is tax year 17-18. So we'll deduct £3,000. Then we'll deduct the £3,000 annual exemption brought forward as well. So the remaining amount is going to be £184,000. Right? Now then we'll have to deduct the nil rate band, available nil rate band. Now because in order to calculate the available nil rate band, we will have to see the date of gift. Date of gift is 19 December 2017. Now we will have to see the 7 years before that. Now if within 7 years, if there is any CLT has been made, or PET has been made, now the nil rate ban will be used against them first. Now there is one transfer which was in 2012, which is within 7 years, so it was £260,000. So the nil rate ban will be used against that first. Remaining amount of nil rate ban will be used against £184,000 of our value. Right? So up to that amount there will be tax at the rate of 0%, and on remaining amount there will be tax at the rate of who is paying the tax? Paul made a gross return on how much IT payable by Paul. So Paul is paying, so there will be 25% tax on that. Right? Now that is question number 160. Let's do question number 161 as well. So that is question 161, value of PET it is asking. So I've already listed down the list of questions so that which topic it is and which question it is. So question number 161, as you can see on your screen as well. Pause the video and do this question for me. Right, so it says Donald excuse me. Donald made following transactions in the taxes 17-18. Now ignoring annual exemption, in the requirement it says ignoring annual exemption, what is the total value of potentially exempt transfer made by Donald as a result of these gifts? Now gift of £2,000 to his granddaughter on the occasion of marriage. Now up to £2,500 we have seen that on the occasion of marriage, £5,000 from a parent of the marriage, however £2,500 from the grandparents. Alright, so this will be exempt because it is less than 2,500. Right? And the remaining, the second one, it says sale of vase to his friend Alan for £1,000, which both Donald and Alan believed to be the market value of the vase. The vase was later valued by an auction house as worth £20,000 at the date of sale. Now at the date of sale there was value of £20,000. However, both donor and the receiver thought it was £1,000, so it was transferred for £1,000. So in that case as well, the value of transfer is zero, because both party agreed and both party said that it is £1,000. So that's why the value of transfer is value of transfer is zero. So in both cases there is no value of transfer because it says ignoring annual exemptions. Right? Now on excuse me, on question number 162, please. Question 162. Now on question 162 it says ignoring annual exemption, what is the inheritance tax payable by Christian's death in relation to her lifetime transfers? Now Christian gives shares worth £150,000 to a trust on 15th of September 2008, and shares worth £600,000 to her brother on 10th of July 2014. The nil rate ban in 2008-9 was £312,000, and in 14-15 it was £325,000. Christian died on 23rd of October 2017. Ignoring annual exemptions, what is the inheritance tax payable on Christian's death in relation to her lifetime transfers? Now the gift was made in £150,000, and the date of death, the gift was made of £150,000, and it was made in 2008. Now the date is 2017. Now if we look at current date of death is 2017. If we go back 7 years before that, so the 15th of September 2008 isn't within 7 years, so it is outside 7 years span. So the £150,000, there will not be any tax on that. However, 600,000 was on 10th of July 2014, so it is within 7 years period, and at that time the nil rate ban was £325,000. So the date of gift was 10th of July 2014. Now at that time the nil rate ban was £325,000. Now we will have to see 7 years before that how many gifts have been made. Now 7 years before that there was one gift of £150,000. So this £325,000 nil rate ban will be used against £150,000 first, then the remaining nil rate ban will be used against £600,000. Alright? Now up to the nil rate ban it will be at the rate of 0%, and above nil rate ban there will be tax at the rate of 40%. Right? And because it was a potentially exempt transfer, so there won't be any gross value on that. Right, so I hope that you can calculate it, and you have already calculated it. There isn't any problem with regards to that. I'm not going to do this question or any of the questions. I'm just going through, because you know there is lack of time as well. So we will be doing a lot of questions. Now we've done question number, which one? Question 100, which one is? Let me see which question we just did. 162. Right, now we have to do question number 165, please. Question 165. Question 165 of PPP exam kit, as you can see on your screen. Now it says how much inheritance tax will be payable on Susan's death. She died on 19th of November 2017. Her death consists main residence worth £300,000. So that is her main residence, which is amounting £300,000, on which there was a secured repayment mortgage of £220,000. Right? So and the investment in cash totaling £325,000. Susanna left her estate equally to her son and daughter. She was divorced from her husband. Susanna had not made any lifetime transfers of value. Right? Now in this case, £300,000 is a main residence which is transferred to the direct relatives. Now £300,000 will take £300,000. We will have to deduct any payments against that. So there is a mortgage against that, which is £220,000. So the remaining amount is £80,000. So that is the remaining amount. Now that is £80,000. Now we can use our we can use our residence nil rate ban against that amount, against that figure. So we will use our the residence nil rate ban against this figure. So it will be there will be no tax on that. However, for the other estate, which is £325,000, so we will use the nil rate band against that. So up to the nil rate band there will be no tax at all, and above nil rate band there will be tax at the rate of 40%. Right? Right, then we have done question number 165 as well. Next question is 167. We have already done that, date of payment. 168, which is 168, please. Question number 168. Just give me 1 second. Question number 168. Right, what is the amount of inheritance tax received by Benjamin's grandchildren? Now, in this case, someone was died. Benjamin, it says, Benjamin died on 30th of November 2017, leaving estate valued £890,000. Her estate value is £890,000. Inheritance tax of £276,000 was deducted. So we'll take £895,000 less tax deducted of £276,000. After that, under the terms of his will, Benjamin left £260,000 to his wife, so that amount will also be deducted. A specific legacy of £120,000 free of tax to his brother, so that amount will also be deducted. And the residue of estate to his grandchildren, so the remaining amount is for grandchildren, and that's what it is asking in the question. In the question it says, what is the amount of inheritance received by Benjamin's grandchildren? So that is the amount. Right? So we'll take £890,000, we will deduct £276,000 as tax. Then we will deduct, Benjamin left £260,000 to his wife, we will deduct that amount. Then we will deduct £120,000, remaining amount to his grandchildren. But please remember, if in this question, if it would have asked that who will pay this £276,000 of tax? Now in this case, the tax will be paid by grandchildren. Alright, so grandchildren will be the ones who will be paying the tax. So whatever the remaining amount is, that is our answer. Let's do question number 171 and 172. We are doing more questions with regards to the residence nil rate band, because that is new in our syllabus, so that's why I thought we should do a little more questions. It says, now read the requirement. It says, what amount of residence just read this question please and try to resolve it while I drink some water. Right. Right, so it says what is the amount of net residence nil band will be available in computing inheritance tax on Nadia's death estate. Now, Nadia died on 6th of December 2017. Her death estate included main residence, which is valued at £350,000, on which there was a secured outstanding mortgage of £180,000. So £350,000 less £180,000, how much? £170,000? Please make sure you redo it. I think it's 170. After that, Nadia will leave her entire estate to her 3 children. So it is a main residence which is being transferred to the direct relative, so that is eligible for residence nil ban. Then it says Nadia is a widow. Her husband died in 2009, leaving entire estate to Nadia. So her husband has died as well. So he transferred whole of his estate to Nadia, which means he did not use any of his residence nil band, which eventually will be transferred to Nadia. So now Nadia has 100,000 her own and 100,000 transferred from her husband. So she now has £200,000 to use against estate. However, the net value of the estate is £170,000. So in this case, the eligible residence nil ban is going to be £170,000. My throat is so bad. Let's do the last question, 172. Question 172, please. Question number 172. Please read this question and try to solve this question, please. Right, it says Raquel is aged 85 and in poor health. I will have to speak slowly now. She is keen to minimize the inheritance tax due on her death estate, which is likely to have value of about 1.2 million. And her will currently leaves main residence, which is £300,000 to her brother. So it is a main residence which will be transferred to her brother. It is eligible for nil band, residence nil band. And the residue for estate to her son. Raquel has never been married, so she's not married, which means that she does not have any unused from her husband, so she only has £100,000. Complete the following sentence by matching the correct response in each space. The inheritance tax liability on Rachel's estate will be increased or decreased by dash amount if she leaves her main residence to her son rather than her brother. Excuse me, sorry, I read it wrong. It was transferred to her brother in the question, and then in the requirement it says that if it would have been transferred to the son, would there be any benefit? Yes, there would have been benefit if it was transferred to her son. And it would be decreased by £100,000 because that is a nil band. Her main residence is £300,000 worth, but we can only use the residence nil band of £100,000. So yes, it will be decreased, and it will be decreased by I guess £100,000 because there is no expenses attached to that, is there? So her will currently leaves main residence £300,000 to her brother, and the residue of her to her son. Never married. Complete the following sentence. Inheritance tax liability, it says. Sorry, I beg your pardon. It says the inheritance tax liability. It is not asking the residence nil ban. So it is confusing statement. Even I got confused. So inheritance tax liability on Rachel's estate will be decreased by dash amount. So because the inheritance tax liability, we got in a residence nil ban of £100,000. So on that, we will save tax at the rate of 40%. So that is £40,000. It will be decreased by £40,000 if she leave her main residence to her son rather than her brother. All right. So that is question number 172 for you. Right, as we have now finished our this video lecture, and we have finished our inheritance tax as well, as far as F6 is concerned. We will do more questions, and we'll have more topics as well for inheritance tax in our next video, which is for P6. For F6, that's it. This was just one lecture for F6 purposes. We've done all of these questions as well, which I've listed from question 159, 58, 59, 60 up until 172. But please remember, for F6 students, please do the lengthy questions as well. For section C questions, we just did the MCQs questions. Please do the section C questions as well. I will see you in the next video lecture, and for F6 I will see you in the next video lecture for corporation tax, and for P6 student I will see you for inheritance tax. I will see you in the next video then, and just pray that my throat gets better. I'll see you in the next video. Goodbye.